On August 18, 2026, the yield on the benchmark U.S. 30-year Treasury bond touched 5.327%, reaching its highest point in 19 years. The pressure synchronized across the Pacific. That same day, Japan's 10-year government bond yield broke upward to hit a 3-decade peak, driven by intensifying inflation worries. Markets in Europe faced the same volatility. Long-term borrowing costs in Germany and France simultaneously spiked to multi-year highs, signaling broad distress across the world's primary sovereign debt markets. The immediate market consensus pointed to a collision of isolated events. Analysts blamed the dragging U.S.-Iran conflict, the scale of U.S. deficits, and the unexpected resource demands of the technology sector. The artificial intelligence boom had escalated into a severe capital competition. Hyperscale tech companies were borrowing heavily to build out infrastructure, suddenly vying for the same pool of capital the government used to fund its debt. This specific vortex of geopolitical stress, technological borrowing, and financial strain was explicitly mapped out in a series of public documents 6 months earlier. The chaos of August 2026 operated according to a calculable phase transition, predicted point by point through a truth-neutral philosophy of science framework. This framework is the Bridge360 Metatheory Model. It functions as a governance algorithm designed to measure system fragility, distinct from traditional economic forecasting. On February 12, 2026, researchers registered a forecast with the Zenodo repository. The document explicitly detailed an impending liquidity crunch, aggravated by a sensitive Federal Reserve leadership transition in May. A second advisory, filed on March 26, focused on the Asian markets. It identified Japan as the primary early warning platform, indicating that Japanese yields would serve as the transmission node for a global systemic failure. The model employs what researchers call the handshake protocol. This protocol provides abstract philosophical architecture and invites domain scientists to translate those concepts into measurable, real-world observables for testing. By placing the qualitative Bridge360 forecasts from early 2026, the priors, against the hard Reuters financial reporting from August, the posteriors, we can cross-examine the model's accuracy. Verification of these registered priors against real-world reporting moves Bridge360 from philosophical seeding into an operational governance protocol capable of mapping systemic risk. The Bridge360 framework relies on a thermodynamic metric it calls navigatable, evaluating whether a complex system can maintain its internal coherence under immense pressure, rather than seeking an absolute economic truth. It operates on the commitment that physical, informational, and social systems do not exist in silos. Instead, they all inhabit one unified geometry of entropy. The optimal stability of a system is represented by a central, navigable corridor, the epsilon spine. The normalized entropy eigenvector measures a point's distance from this center. Outer boundaries are fragility caps. Passing this red line means losing ability to manage internal chaos. Because the model treats divisions between physics and political science as governance conveniences, the same rules of corridor stability apply across both domains. By tracking the accumulation of systemic entropy rather than waiting for traditional financial indicators, the model identifies the deep structural fractures that precede a crisis. The February 2026 Zenodo deposit reveals a precise observation regarding the behavior of major technology executives. The model logged a unison signal. Big tech firms were committing over $500 billion to AI infrastructure while simultaneously executing massive workforce layoffs. Classical economics viewed this AI boom as a localized sector optimization. Technology firms were simply reallocating resources, a move seen as entirely separate from the mechanics of sovereign debt. Bridge360 diagnosed this corporate unionism as a volatility paradox. The model stated that aggressive local optimization in the tech sector was actively masking deep global structural fragility. The model predicted that consolidating this much liquidity into server farms would create an extreme thermodynamic load, forcing tech companies to compete against government bond issuance for available capital. This comparison demonstrates the first successful handshake, matching the February warning against the hard August reporting. Reuters analysts confirmed the mechanism the model predicted. Because AI hyperscalers were siphoning off immense amounts of capital, investors demanded higher returns to continue absorbing U.S. government debt. In Bridge360's entropy geometry, the tech sector's AI build-out provided the exact thermodynamic weight that cracked the U.S. Treasury market stability. The analysis then shifts to the March 2026 Zenodo document, originally drafted as a strategic advisory to the Tokyo Chamber of Commerce. Bridge360 designates Japan as a high-fidelity transmission node, the primary early warning platform for a global systemic rebalancing. The advisory logged specific, measurable early warning thresholds: Brent crude exceeding $120, bank swaps past 50 basis points, and AI write-downs crossing $10 billion. By August, the energy threshold was under acute pressure. With U.S.-Iran peace hopes fading, oil pushed back above $90, closing in on the model's stated trigger point. The model accounts for these events as perturbation vectors, discrete external shocks that apply sudden force to a system, pushing it toward its fragility taps. The February deposit mapped two vectors converging: the friction of the Iran war and the anticipated May 2026 leadership transition at the Federal Reserve. The transition to Kevin Warsh acted as a phase transition perturbation, altering the Fed's reaction function just as the Treasury needed to refinance massive debt. The August spike in Japanese yields to a 3-decade high fulfilled the model's prediction, confirming Japan's role as the early warning node absorbing the impact of these combined vectors. The simultaneous shocks hitting Washington, Tehran, and Tokyo were governed by the same underlying entropy geometry, validating the Bridge360 multi-rail mapping. When loaded with the real-world data points of AI expenditures, geopolitical conflict, and central bank transitions, we see the system pulling away from the navigable spine. Bridge360 defines an entropy blowout as the mathematical moment a system exceeds its fragility caps, causing systemic order to fracture into unmanageable panic. As the combined weight of the perturbation vectors forces the sovereign debt markets outside the corridor, the system experiences a blowout. Classical financial analysts viewed the August yield spikes as a temporary market overreaction, assuming the numbers would eventually return to normal levels. Bridge360 dictates a contradictory conclusion. Because the fragility caps were permanently breached, the August spikes served as the entry point into a structural systemic decoupling. Standard monetary tools like rate cuts or quantitative easing function by adjusting the cost and supply of money. However, they lack the capacity to address the structural distortion of the entropy geometry itself. Once the corridor fractures at the fragility caps, the system can no longer process these inputs coherently. Injecting liquidity into a broken geometry fails to restore navigability, rendering traditional stimulus ineffective against the resulting decoupling. The final registered component of the February Zenodo document is a macro-financial forecast window, mapping risks from late 2026 into early 2027. The model outlined a high perturbation branch, resulting in a severe growth shock, predicting a Q1 2027 GDP contraction between -0.5% and +0.2%. It warned of a cascading failure profile, where the volatility of the 2026 midterm elections and the threat of a government shutdown would directly compound existing bond market stress. The final modeled threat is the risk of total Treasury auction instability. This occurs if foreign buyers retreat from financing expanding deficits during this liquidity trap. The handshake protocol proved that abstract philosophical architecture can accurately map empirical financial crises months before they materialize in the market. The model delivers a precise final lesson for policy architects. Ensuring systemic survival requires abandoning traditional economic guardrails and shifting to the active, continuous management of systemic entropy across physical, informational, and social domains.